All right, I think we're gonna be set up here properly.
Yep, it showed that you were live.
Oh, so you subscribed. That's what it is. I am. So let me, I'm gonna set this up where I can share the video inside the group me. Or can you do that from yours since it's live? Will it let you send? I got it here. I got it.
You
Okay, here, guys, we're gonna get started here in just a second. Set it up so I can share the live feed with the team. Okay, trained trainer. Host. See, Jasmine, can I see you and I? Let's see here. All right, we see Jasmine, we see Ronese, and we are ready to go. Good. All right, guys. So this morning, this training is going to be on training the trainer. So what we looking at this morning is how you do the presentation effectively. So Jasmine is going to actually we doing it on video live training, but Jasmine is going to get my actual critique, and so I'm kind of going to be a tough butt on her. But she's a tough woman. She's a child, so I'm gonna be a little bit easier on her than I normally will. But I'm gonna listen to her presentation, guys. We're gonna start from the standpoint of we're gonna already assume, Jasmine, that you already was in the house, you already built up form, and you going into the presentation. So what we looking at and what we want to make sure that we perfecting is transition, how you move from one page of the presentation to the next page, how you capture your audience and keep them engaged as you sharing with them Primerica's concept. Because one of the things that's important is that not only that you know how to say what's on the presentation, you know how to read the words, but you got to keep your audience engaged and captivated. And you got to make sure that you're moving them around to your way of thinking. And so those are some of the things that we're going to particularly focus on. And then lastly, even when we transition in from the presentation to the closing of the sale and the recruiting of the client. So without further ado, Jasmine, I am your brother Rico. And no, I'm not your brother Rico. I'm Angie's brother Rico. And Angie brought you over to field train with me. So without further ado, we're going to get started.
had my presentation. Okay. All righty, how are you doing today, Mr. Rico?
I'm doing fine. How about you?
I am well. Angie introduced us. I'm glad. Thank you, Angie, for having us. And again, I'm Jasmine. And do you know anything about Primerica? Have you heard anything about us prior to today?
Hey, y'all an insurance company.
Insurance, okay. Is that good or bad for you?
It's pretty good. I got a lot of it already. But my brother used to do it. I don't think he do it no more though.
Okay, I hear that a lot. Okay. But what we'll do, I want you to hear it from me, and I can help you better understand who we are.
Okay.
Okay. So we are Primerica, the largest independent financial marketing of North America. Okay, we are traded on the New York Stock Exchange currently at about $96 per share. We started trading publicly in 2015, so that's a big deal. And it was about $15 a share. And now with it being at 96, you can say that this is a money-making company. Okay, and then we do currently at this point service more than 2 million clients in the investment accounts, and more than 5 million of those clients are also insured with us, okay? And then we are also listed top 50 on the Forbes magazine. If you know anything about Forbes, that is the money magazine, right?
Yes.
So you can only get in the magazine if you're making money, correct?
Correct.
Absolutely.
All right. So that's the first part of the presentation, guys. So what I would look at is just two things. One, as Jasmine giving her presentation, she's holding the presentation and she's looking at it this way. So if I'm the client, then when I'm giving a presentation, then all of these little small things matter, guys, when you're in your appointment. So if she holding the presentation this way, then I'm looking and she got me reading sideways. Does that make sense? So if I'm having a presentation this way, then I should have the presentation angle where the client can see it. I'm reading upside down, but I'm really not reading upside down. Why?
Because you should know.
Because I should know everything that it says. So Only thing I'm looking at is a reference point because I know exactly what my presentation should say. So, as she talked about, have you heard of Primerica before? And then I said, well, they're an insurance company. And she asked the question, well, is that a good or bad thing for you, right? So you missed my training on Saturday, didn't you? Was you here Saturday?
I was there.
You said Saturday? What was training this Saturday? Last training, was it Saturday or Monday? Saturday training.
Saturday.
So Saturday I talked about how you read their body language, right?
Oh, yeah.
So they say you don't have to ask them is that a good or a bad thing for them because I don't necessarily want them to say that's a bad thing out of their mouth or they had a bad experience. I want to read their body language. So I said I heard of Primerica before. So it's a couple things, guys. Somebody said they heard of Primerica before, then I won't say is it a good or bad thing. I said, well, great. Well, what do you know about the company? And I said it's an insurance company. He said, well, is that a good or a bad thing? Well, I got a bunch of it. I'm not asking that. I said, what have you heard? I heard that you're an insurance company. So then that's my guide. Yeah, insurance is one of the things that we do. We're actually a financial service company. And today I'm going to share with you the total concepts of who we are and what it is that we do.
Okay.
So the main thing is holding the presentation this way, right? I can see everything that you're saying. And then you got to think about what points that you want to elaborate on. And you talked about how we opened up at $15 a share. And today we trading at $96 a share. So you picked your points on what you wanted to highlight. So that was good. But make sure you're holding the presentation this way so I can follow along as a client.
Okay.
All right? So keep going. The other thing, guys, if you notice, I'm using a pen. Why am I using a pen? Because I want the client to be able to follow along with me. And then plus, if you're a person that you wear dye in your hair or something like that, if you scratch your head, then you get dirt up under your fingernails and stuff like that. So, or if you're a woman, you might have a lot of diamonds on your nails. You don't want people focused to be on the wrong thing. So sometimes when you point and like I need to get my nails done, you see that my cuticles or whatever they're called is all popping out right there. You'll be amazed at some of the small things that can distract your client. So I want to make sure that I'm pointing with ink pen and they follow along with an ink pen because that leaves no distraction. They're not focusing on the wrong things as I give my presentation. So she's gonna pick up at our mission statement.
Okay. Alrighty. And our mission, okay? We're gonna go over our mission, and our mission is to help families earn more income with that, because in today's economy, we know that a lot of people are not making enough money that they would like to do that. So a part of our mission, we help our families earn more income, and then and we help become properly protected, because we know when you hear, do you have life insurance? What is the response for most people?
They don't have it.
They don't have it, or if they do have it, they have it through their job, okay? And when we have it through your job, is that your policy? Can you go physically get a policy from your job for that policy?
Yeah, I think actually I got a policy through my job. I got one.
Okay, are you able to go and get that actual and see what the amount of your policy is? If something happened, who can take the benefit for your policy? Do you know if you can physically touch that policy?
I mean, I got it. I got a copy of it. They gave me a copy of the policy.
You got a copy of it?
Yeah.
Okay, do you know the benefits in it?
In my policy, I got 100,000. So like if I die, my wife get 100,000.
And it's guaranteed. So if you lose that job today, is it guaranteed that you could still have that policy?
Yeah. I
Okay.
got the kind. Yeah. You keep it always.
You
to
can
the end.
keep it.
Yeah.
Okay. Well, that's the best way to have, but most people don't have that. So we do want to work with our families to make sure they are property protected. So if they do have the job insurance, they are able to keep that whenever they part ways from that job. And then we also want to help our families live debt free. Debt free is meaning, okay, you can go in and you have your, we teach you how to not be struggling in your bills monthly, teach you how to save, teach you how to invest in that area. And that's how we teach you to become debt free and then also financially independent. That's comes in that aspect. You want to make sure that you're living the life that you want to deserve. What would you like to do on your free time?
I want to go on the beach.
On the beach. We would help with that and make sure that you can afford to go on the beach, because we have those families that can't afford it. And so that's what our mission is here as a whole, to make sure that you can do the things and live the life that you deserve.
Absolutely. All right. So one of the things, guys, as she gave it, so she did a great job at explaining our mission statement. One of the things you want to focus on is when you say our mission is to help families, number one, earn more income, because the biggest challenge is that we have is people don't make enough money. Jasmine talked about that. What I will veer away from, Jasmine, and I will make sure that's not happening. I don't want at this juncture for the client to feel like I'm talking to them.
Okay.
I'm not trying to overcome no objections right now. I'm not trying to create any objection. So you asked the question like, you had it on the job. Can you get it? I don't want to talk about none of that right now. I'm gonna give you some information to put something in your brain so you can be convicted by it. And then when I get down to the closing part of it, right, I can start unfolding things. So all I want to do right now is just prick your heart. But I don't want to get into a tug of war with you, whether
Exactly.
if it's that kind or this kind. So all I want to say is that our mission is to help families don't want to earn more income. Because the biggest challenge that people have is they don't make enough money.
Right.
And so we help them through our part-time opportunity, earn more income, become properly protected. A lot of people have insurance only through their job, but if you lose the job, you lose the cover. And so not only that, they don't even know how to file a claim. They don't know who they need to contact. So what we're doing is we want to make sure that they're properly protected, debt-free, but also move them towards financial independence. And so financial independence just simply means that you got enough money that you don't have to work for it anymore. Does that make sense? All right. Jackie, we back here. All right, go to the next section. So again, just remember on our mission statement, or even on this front page, you're not talking to the client.
Okay.
All you looking for is I want to prick your heart, I want to convict you, so
Okay.
you taking some things in, but I don't want no dialogue necessarily with you. I just want to say something that's going to make you uncomfortable, because when we get down to the close or we get into the meat of the presentation, you remember some of the things that pricked your heart earlier. I'm just setting my tone right now.
Okay.
Not to get into what you personally got going on, but I'm gonna make some statements around you,
Okay.
right? So I'll make a statement like most people only have insurance through their job, but typically when they lose a job, and I say words like typically because all job insurance ain't so goes the job, so goes the coverage. Some jobs let you actually take your coverage with you. Some jobs actually do give you a policy. Most of them don't. So you gotta use words like typically. You don't have a policy. Typically, you don't know the coverage. And who do you call when you die? Who do you file a claim with? How do you have to die to receive the rewards? So I'm asking those questions so that if they only got insurance through their job, if they didn't receive a policy, they're sitting there feeling like, oh my God, that's right, they didn't give me a policy. Oh my God, I don't know who I need to call if something happened. Right? So all I'm doing is just, I'm whetting their appetite. I'm showing them, you know how they come through at the fancy restaurants with the dessert tray? And that ain't the kind, that ain't for you to go bite in. That's just for to whet your appetite. You say, ooh, I want some of that cheese. They're getting your mind ready. So after this meal is over with, you ain't finna run about her. You finna buy some dessert. And they gave you a platform of what to choose from. All you doing in the mission statement is saying, I'm reaching out right now and I'm showing you this platter. And in this platter, you're going to somewhere on here, it wets your palate. Does that make sense? So again, our mission is to help families earn more income. Because the biggest challenge that we have, now I'm not talking to them about their personal lifestyle, but I'm saying the biggest challenge that people have is they don't make enough money. Right? They don't make enough money. So our job is help them make, on a part-time basis, extra $500 to $1,000 a week because it subsidizes their lifestyle. We want to make sure they earn more income, become properly protected through their life insurance. Because in our community, what we find is that most people don't have any life insurance at all, or they don't have enough. So we want to make sure that they earn more income, become properly protected through their life insurance, debt-free, and move them towards financial independence. And then I want to transition. So next thing I want to see you do is how do you transition from this page into our next concept? Because everything got to feel like it's one story. Can't feel like it's choppy parts, right? So I'm thinking about how I'm wrapping this up. Our mission is to help families earn more income, become properly protected through their life insurance, debt-free, and financial independent. How are we now transitioning over to the next page?
Okay. Now this one, let me make sure we include these though?
I don't usually talk about how we do
yeah, I
it
don't-
because as I get through the presentation, it's gonna tell you how we do it. So it ain't wrong for people that do go into how we do it, but I'm finna talk about how we do it,
Right.
right?
Yeah. Okay. Okay, so how we usually do this and with our families, we teach them simple concepts called the rule of 72. Well, hold on. No. Wait a minute. Oh, we teach people how money works, okay? This is how we typically do this, okay? And we show them how your money is used in the public economy with the banks, okay? So how much interest do you think that you're getting on return from your money that you put in your bank account?
Probably about 5 or 6%.
5 or 6, that would be great. However, that it's definitely less than that. It's about 0.25000. It's less than 1%, okay? And
No, I bring for commerce. I can get like 5 or 6%.
that's great.
right? So remember, you're always not talking to them,
Oh,
right? Because you talking to, so at a point I would answer that, but I'm almost give them the answer.
give them the answer.
Because most
okay.
people outside of Primerica don't know what interest rate they get. No, like
They
before you
don't.
worked it, have you ever looked at your statement to
No.
see what kind of interest you get?
No.
You haven't.
No.
So you don't want to put them in a position where they give the wrong answer
Give
because
the
then
wrong
they gonna
answer.
feel like, oh, I forgot how to stop my phone so it won't ring. So you want to make them feel like they're done. So I don't want to. I want to keep from asking unguided questions. I want to guide them to the answer. So that when I go into this page here, so what we do is we teach people how money works. And
Okay.
typically when people get their paycheck, they save their money in a bank, a credit union, or insurance company. But historically, they give us low rates of return. Like most savings accounts got 0.002.25. They don't even give you 1%. Like who do you bank with now, Jasmine?
U.S. Bank.
U.S. Bank. What are they giving you on your savings account? See, I already gave her a guide to reference from. And so then she'll say, well, not even 1%. Or maybe she say, oh, well, my bank give me 2%. If she say her bank give her 2%, you know what I'm gonna say? That is awesome.
That's
Cause I know it ain't right, but I ain't gonna challenge you because then we can't get through my presentation and you won't be open to my concept because you trying to prove that you right and I'm wrong. So they say they getting 2%. That even lets me know even more that much more ignorant. They unlearned.
Okay.
So I'm not gonna argue with them. They think they get 2%. That's still to my favor because what 2% gonna do?
Nothing.
Nothing. I'm gonna hit you with the rule of 72, and that 2% you think you got that was good, you finna see how bad it is. Does that make sense? So so how do we do that? We teach how money works. And we talk about how most people take their money, they save it in a bank, a credit union, or insurance company, which historically give us real low rates of return.
Okay.
Right? And the bank, they don't got our money, keep it in the drawer, so move forward from there. Okay.
Okay. Alrighty, and the bank, they don't usually keep our money stored in a drawer with our name on it, right? They
Right.
take it into the public economy and they give it out for such things as credit loans or car loans and things of that nature, right? So they basically loan our money out to the public. It's not sitting waiting for us to come back, okay? And then what we also teach is the power of compound interest, okay? You see here at a 3% interest rate, when you're saving $200 monthly for 37 years, you're gonna get a return at 3% of $162,000.
Right. So now she explained that greatly. Like the concept makes sense. Compounded interest, 3% over 37 years, putting in $200 a month, you're gonna get 162,000. However, she didn't capture me. So you gotta make sure that I'm here with you, right? So in my transition, right, I'm looking at, so most people, they say their money in a bank or credit union or insurance company, who historically give us low rates of return. But see, the bank don't keep our money, Jasmine, sitting in no drawer waiting on us to come back and get it.
Right.
They take our money and they invest it in the global economy. So if you got $10,000 sitting in the bank, Jasmine, that $10,000, if I want a credit card, they gonna loan me your $10,000. Now they gonna loan me that for free, or they gonna charge me interest.
They're gonna charge you
They gonna charge me interest. Now what percentage rate you think they gonna charge me?
at about 12%.
At least 12%. So they charging me 12%. What they giving you?
Right. Nothing.
They're not giving you anything. So we talk about the power of compounding interest. And if you look here, Jasmine, at a family that's just putting away $200 a month, they did that for 37 years. See, if the bank was just willing to give you 3%, you would have accumulated $162,000. But if you got 6% on that same $200 a month investment, you got over $327,000. But if you got 9%, access and mutual funds and things like that we're going to teach you about, at 9%, you accumulate over $714,000. You nearly a millionaire, and all you did is put away $50 a week. So Jasmine, if I call 3% Bank A and 9% Bank B, which one would you rather be banking with?
9%.
9%, because 9% just make more sense. Wouldn't you agree? So it's a difference in the transition. I talked about how money works. I talked about how they take our money and put it in the global economy. But I invoked her into the presentation. I said, Jasmine, they ain't got your money sitting in a what?
Drawer.
It ain't sitting in the drawer. It ain't waiting on you to come back and get it. So if I borrow $10,000 from the bank, they gonna loan me what? Your 10 grand.
Right.
And when they loan me your 10 grand, they gonna loan it to me for free, or they gonna charge you.
They're gonna charge.
So I want to paint the picture with her that you put money in the bank and the bank making a ton of money off of your money. It's just to really illuminate that somebody's getting 10% out here. Somebody's getting 12% out here. And if I paint the picture that the bank borrowed your money and loaned it to somebody else, it lets you know somebody's getting 10 or 12%. So if you know somebody is getting, then you know it's possible that you can get it too. So that's what you're doing on this page. You want to make sure they understand somebody's getting 10 to 12. It just ain't you. How can we fix that? That makes sense? So you got $714,000 that you've accumulated. If I call 3% Bank A and 9% Point B, Bank B, Jasmine, tell me, which one would you rather be with?
Definitely Bank B.
Bank B makes more sense, right? So now transition from that page. Just remember, you talking about the power of them getting $714,000. They told you they want to choose Bank B. What's your next page? What's your next concept?
We go to. We don't need to do the Rule 72, because I mean.
If they bought all the way in, but this act like I ain't excited yet. You ain't got me yet.
Okay.
So my transition from at 9% you got 714,000. Now how do you transfer that? I'm coming right off that word. At 9% you got 714,000, almost $1 million.
Almost $1 million.
Now how you gonna transition from that powerful statement to the Rule of 72? Because you got to now you can bake the cake.
Bake the cake, right?
Now you got to put the icing on top of it.
Okay, so you have almost $500,000 saved, right?
Yeah.
Well, no, you have almost $1 million saved, right? At the 714,000, right? So what we move on and transition to is the Rule of 72. Okay, and we show you how you can get close to that 700 and.
That's perfect. See, so now you got 714,000. We're gonna teach you a concept called the Rule of 72 to show you how that's even possible. Cause they sitting here wondering in their brain, how in the world you getting 714,000, $1 million, and all you putting in is $200 a month? How's that possible? See, so you transitioning because you clearing up their mind. That's all your presentation. All you doing is you changing their way of thinking. You clearing up any misconceptions, anything they may not understand. Your presentation is supposed to clarify all that. So you got to put yourself in the client seat or the prospect seat. When somebody first started explaining this stuff to you, it was cloudy. Right? One of the biggest challenges that most people that I train, they say, I can get everything else down. I can't explain that Rule of 72. So if they have challenges with explaining the Rule of 72, then you know the client sitting there like, what is, how's all this 9%, 6%? They ain't heard about no percent. Does that make sense? Only percent they know is the battery on their phone. I'm at 30. That's the percentage that we understand, but battery on my phone. So that was the perfect transition. So at 9% you got 714,000. But how's all that possible? See, the banks, the credit union, insurance company, you always piggying back on where you left. How's this possible? See, the banks and the credit union insurance company, they use a simple concept called the Rule of 72. And that tells you the approximate number, so you feed right back into it. I'm always reaching back so I can move forward. So your presentation is reaching back so you can move forward because you got to pull it all together. Does that make sense? And your transition is just, all transition is I'm reaching back to what I just said or the concepts that we just talked about so I can move it forward. Because I got to bring it, every time you got to be closing the gap. You got to be closing the gap. You got to feel like you're telling one story, not a bunch of choppy parts. Nobody wants to be a part of a presentation, say, and we do this, and we do that, and we do that. They think in their mind, when you gonna be done? Does that make sense? But if you like one story and you're bringing it all together, right? I hate the movies where you jumping in this scene, then all with Betsy over here, then Reggie over there, and all this, somebody just got killed. Now somebody baking a cake. I hate that. Show me they got killed. Show me who killed them. Show me how you trying to catch the killer. That's how I need my stories to go. Does that make sense? Don't jump off to a love scene. Somebody just got shot.
Right.
So that's how you want to think about translation. So great transition. Pick up on the Rule of 72.
Okay. And we show you ways of simple concepts called the Rule of 72 of how you can get that 714,000, right? So with the Rule of 72, this is the simple calculation that the bank uses to let you know when the amount of when your money is going to double. Okay, and so we look here at 3% when you place a 10% in a bank account here, and you're gaining interest at 3%. Okay, you look over here, 72 divided by 3 is what? 24, right?
24.
Okay, so we look at this, 24 years, we have $20,000 saved. Okay, how many 24-year period do you think you have for your money to double at 20 to double?
I mean, I'm 42 years old, 43 years old right now, so I got two of those left.
Well, and that's the concept of most people, right? When we look here, by the age of 48 at 3%, you're only going to have $40,000 save for retirement? Can you retire on this, or do you think you need to go back to work?
I gotta go back to work.
You definitely have to go back to work. And then we come over here and we look at 6%. It's a little bit better. 72 divided by 6 is now 12. So your money is now doubling every 12 years, okay? And so we look at here at the end of the 48 period, it's 160,000. That's a little bit better, but pretty sure you're going to have to go back to work as well on that, because once you buy your favorite car, whatever it is, the money is depleted. Then we look here also. This is again 10,000 on each one.
Okay, so here's the challenge with your presentation.
Okay.
Right, and a lot of people have the same challenge, right? It'll rock us to sleep,
Okay.
right? So I gotta be more engaging. I gotta get them more involved. I gotta act like this is a problem for me. And you're enacting it is a problem, but I don't feel it.
Okay.
You see what I'm saying? So people make decisions based on their emotions more than likely, and not just from information. So how do Jasmine engage me?
Okay.
Right? So you got to crusade their heart. So the sales process is really crusading their heart. The one reason that I'm effective in closing because I'm trying to reach inside your heart. I'm trying to make you feel a certain way. You remember I did the training on Are You Feeling Me? Right? I ain't feeling you right now. So in this, your whole thing is to shake me up. Make me feel disturbed, right? Because right now you give me some information, but it don't bother me. I'm like, okay, I'm cool. Still keep my money in the bank. So I'm not. So you got to be thinking about in your presentation. So the rule of 72, you take the number 72, you divide it by whatever rate of return that they getting on their money.
Okay.
So if you think about it, if you're getting only 3%, right? We talking about 3% would only get you down. So I can go right back to what I just talked about.
Yeah.
That 3% there was only gonna get you 162,000, but 9% got you closer to
$1 million.
close to $1 million. So you rather have the $1 million. See, what's happening is the bankers, we go in, they take advantage of us.
Okay.
They don't have anything in the lobby showing us how to get a better rate of return. Because look at this, 72 divided by 3. Think about this. If you put $10,000 in this account, it takes 24 years before that 10 becomes 20. It takes 48 years before it becomes 40, and you get to retire with 40 grand. How your retirement gonna look, Jasmine?
Sad.
See, that's a difference.
It's a difference.
We take the same information, but I'm upset. I'm engaged. This is not right. That's the feel that the people gotta have. Okay, we back. So 72 divided by 3, it takes 24 years for your money to double.
Right.
Jasmine, how many doubling periods would you have left in your life if it takes 24 years for that 10 to become 20?
Not too many.
Right? But you see my eyebrows?
Yeah.
Right? I'm engaged. That's what. So I want to feel that from you. So I want you to be like, right now, think about this. See, all your gesturing and all that. Think about this. If all you getting is 3% on your money, 72 divided by 3, it takes 24 years. You see how I chop my word up? 24 years. You say it takes 24 years.
Right.
It takes 24 years for your money to double. See, they got to get involved with you then, because they feel your passion. You don't got to talk in the pitch talking, but you gotta
Grab their.
yeah, you know, like when your son, like if you talk like that when your son is tripping, I see your voice change because you want to capture his attention. Right? When he acting good, you talk to him mellow, but when he gets to jumping off the couch, there's a point that you want to capture me. So I want you to focus on 72 divided by 3 right now. If all you getting is 3%, it takes 24 years. I want you to say it just like that. You're 72 divided by 3 right now. If you it takes 24 years.
Okay.
Pause and for your money to double. And 48 years, all you're going to have is 40 grand. Now, what type of retirement are you going to have? See, now I'm thinking, I'm putting myself at 70 years old.
Right.
And you ask me with 40 grand, what kind of retirement I'm going to have? I got to think about that.
Right. Right.
See, so give it to me that way.
Okay. So, so we look at the rule of 72, right? So if we take 72 divided by 3, it's going to take 24 years for your money to double, right? And if you're retiring with 40,000, what does your retirement look like?
Yeah, so be mad about what is your retirement going to look like?
What is your retirement going to look like?
No, what is your retirement going to look like?
What is your retirement going to look like?
Yeah, say it like that. Like, put your hands up. Like, what is your retirement going to look like?
Yeah. Okay.
All right, so ask me that part again.
Okay.
So you have 48 years, you got 40 grand.
Okay. You have 48 years and you have 40 grand. What is your retirement going to look like?
Not going to look good.
It's not going to. You're going to have to go back to work. And in retirement age, would you want to go back to work?
Not at
Of
all.
course not, but this is forcing you to have to go back to work. And so we look here on the better end, the better spectrum, 72 divided by 12, your money is doubling now every 6 years. That sounds a whole lot better. How would your retirement be if you're retiring at 2.5 million?
That's gonna be much better at 2.5.
Exactly. You can live the life that you deserve to live for retirement, correct?
Absolutely. All right, so good. So, Jackie, you gonna switch to get in the hot seat. You brand new, but you in the cold. Come on, work it. You can sit right there on that edge. And what I'm
Videotape, because I am really not ready.
oh, we videotaping you.
Okay.
Yeah, this is only for the pros. The videos for the pros.
No.
Right.
Ah, yeah, Jasmine the pro. Yeah.
Oh, you gonna be all right.
Shakira, you got something to give her?
What's here?
She said you told her to come by to pick up something.
Oh, okay. All right. So, Jackie, I want you to go over the change from buy term cash value to buy term investor difference. So you sit there and you want to give it to Jasmine. Jasmine, I'll be right back.
Short-term investor difference.
Yeah, you want to show the example for John and Mary.
All right.
Okay, so typically there's two types of insurance.
Okay.
There's term insurance and then there's what they call cash value. Some people have other names for it, such as whole life, universal life, variable life, but they're all the same.
Okay.
Okay, so we look at this situation. We have John and Mary. They both got $150,000 each on them. No money on the children. Total coverage is $300,000. Their monthly premium is going to be $295,000. Their cash value at age 65 is $124,000. Okay, so with that being said,
That's all right. That's what you doing. You practice.
Come on, you got it.
Practice.
oh God,
You got it. Come on.
okay.
Hold it in.
All right. So what happened? Jackie froze up.
I'm
You got
froze.
it.
You gotta
No,
do
you
so.
got it.
She froze. All right. So Jackie want to act shy. All right. That's how she be doing me on the kitchen table performance too. I don't know. It's just she got it. All right. So good. So all I want you to do this, Jackie. So when y'all think about presentation, so even whether you OG in the company or you new in the company, the way I do the presentation in most cases, I read left to right, top to bottom.
Okay. I got stuck after I got to that.
To the 124,000. So what you stuck about at the
I didn't know
124,000?
where to go after that.
Okay, so I got 150,000 on John, 150,000 on Mary, right? I got nothing on the children, right? And so they paying a total of $295 on a monthly basis. The reason it's so high, right? Because you got to make sure that your client is understanding that the price is higher
Okay.
because they have a what?
Okay, because they have cash value.
They have this that you got to borrow from. So right, so at age 65, assuming you took the policy out at what age?
30.
Age 30, right? That's what this fine print talks about. It's showing you how they came up with these numbers. 9% return. You know what I'm saying? So you're thinking about it, they got $295 they paying, they got $124,000 cash value. So pick up from that point.
Okay,
And always remember this too, as y'all go out to be in the field, the client don't know what you're supposed to say. I'm a client right now. You get nervous around me because you know I know what you're supposed to say, so you try to say it perfectly, and nobody's gonna. Let me let y'all off the hook. Nobody's gonna say it like I said. All right, to make y'all feel comfortable. Nobody's gonna say it like I said. So you just gotta get through it because the client don't know what you're supposed to say. So your nerves supposed to be calm down. At the end of the day, they bought insurance and savings, but they're gonna get one or the other,
okay,
and we show them how to fix that.
okay.
All right.
Okay, so we have, the cash value and the term. We're gonna use this, illustration as if person purchases at age 30. So by the age 65, they have 124,000 saved up into what they call their cash value account. They pay a higher premium because they're getting two for the price of one. And you ask, well, how do I get two for the price of one? You can't die and live at the same time. Am I correct?
Right, you are.
So how do you bundle your cash value with your savings as far as your insurance is concerned? So let's say, for instance, you were to go and borrow 50,000
Okay.
from this. You have 124,000 saved up. The company, how do you borrow from yourself? Do you understand what I'm saying?
I hear that because I want to put emphasis on how you borrow from yourself. Now, one thing that I want to challenge you to do is I want you to use the exact same numbers that I use.
Okay.
Because you always say $50 notice. It's like every time you say the presentation, you
So
say
what is it
50,000.
supposed to be?
It's 100,000.
Okay, 100,000.
So you ain't wrong to say 50, but
50.
but you want. I don't know why you get 50
Okay.
from. Maybe because it say 150. You just easy to just take 50 off and I keep
Okay.
100. But And so it ain't wrong, but it's just we want to make sure we're duplicatable. So if I train somebody and then one day they go out with you, if they hearing the same thing, repetition is the mother of learning. Does that make sense?
Okay.
So I'm gonna run through this, and I want you to say it this way. So think about this, Jasmine. If John, I got 150,000 on John, $150,000 on Mary, nothing on the kids, right? And they paying $295 a month. The reason it's so high is because it built up this cash value savings they can borrow from. And at age 65, assuming they took it out at age 30, at age 65, they accumulate $124,000. Now, at $124,000 in cash value savings, they decide they need to borrow their money from themselves. Think about that, borrow their money from themselves. If they borrowed $100,000 and died the next day, the family only gonna get a $50,000 debt benefit. Why? Because the loan don't go away. It's not forgiven because you died. Your family now who thought they was gonna get a check for $150,000 so they can continue to live in the house that you provided, so they can continue to drive the car that you provided, instead of getting $150,000, they gonna get a check for 50 grand because they gotta pay back the loan that you needed for whatever reason that you needed it for. So when some people figure this out, they say, well, you know what? I just won't borrow from my policy. That way I won't put my family in that position, right? So they don't borrow from their policy. Oh, hey, good. The insurance company love you the more. Don't borrow from it. You died, you never borrowed from the policy. You are correct. Your family get $150,000 debt benefit. But my question to you is, what happened to the $124,000 you saved up? See, because the $124,000 that you saved goes back to the insurance company. It goes back to the insurance company. So who saves $124,000 to give back to the insurance company? Who does that?
Right.
See, you need the client involved saying nobody. In their mind, they gotta be saying, man, this stuff's stupid.
Yeah.
That's why closing becomes easy because they say this makes stupid. I went on an appointment with Nate the other day. They had 15 cash value policies. 15.
Wow.
Now, it's hard to get some people to move 15 policies over. They done had the wrong stuff for 13 years. They ain't easy for them to move it, right? And Angie, they had to wrestle Angie down to the ground to move her little dirty little cash value policies that she had. Did they ever wrestle you to the ground? Yeah. 3 months. Because she didn't want to let go of them cash value policies. But they finally got her, so they don't want to let it go. So the way you're going to get people to move is they got to be looking at this stuff and saying, even though I done had it for 13 years, this is stupid. See, the lady that I saw, she kept saying, man, I done had them for so long. I borrowed from and all this stuff, and she was trying to justify I done had them so long, so I might as well keep it. Or you bought them. So when you die, you can get paid a debt benefit. It doesn't matter how long you had it. When you die, they're going to pay this amount.
Right.
So if you switch them in counseling and move over with me, when they die, we're going to pay this amount. That's all that really matters. It don't matter if you've been screwed 13 years. Do you want to make it 14?
Right.
Right.
That makes sense? So you got to make sure that when all you're looking at on this side is that you got to make sure you paint the picture that you're getting screwed. Does that make sense? You are paying for two things, but you're going to only get. So here's how you focus on the presentation. Right? So you got to transition. I did the rule of 72. They're captivated by that, right? So I want to keep them in that thought process. They're excited about investing money. They're excited about saving money. Nobody's excited about buying life insurance.
Exactly.
So I got to make life insurance as sexy as the investment when it comes to doing it with Primerica, right? So think about it. So the rule of 72, you got $2.5 million. Now, if you got to look at retirement, you got to choose between 40,000, 106,000, 2.5 million. Which one you choosing?
The 2.5.
The 2.5 makes all the sense in the world, but ain't nobody showing us how to get 2.5. That's what separates us from most companies. See, one of the biggest investments that people make is in their insurance. And see, with insurance, there's only two types. You got cash value, and then you have what's called, but this must be your presentation. This yours?
Yeah, that's mine.
Where mine's at?
I don't know.
Because I'm like, this ain't mine.
I think is that it right there?
Yeah, this, okay, I'm not thinking I'm doing mine. I'm like, I don't know why this just jumped out at me or whatever, but I'm just like, this is not my presentation. I'll tell you why I know later. All right. So cash value versus buy term invest is different. So you look at this, John and Mary, all I'm going to do is go straight down this line. If you follow down this line, all I'm interjecting is my personality, but I'm just following straight down this line because I'm telling the story from top to bottom. John and Mary both had $150,000 coverage on them. They got no coverage on their kids as if kids don't die. You got to throw that in there. As if kids don't die. They got a total amount of coverage of $300,000. They paying $295 a month. See, certain things you just got to slow your words down. Break it down. Why? I want an impact. I want you to feel this, right? They paying $295 a month. And see, at age 65, they have this cash value saving. They would accumulate up to $124,000. But if they want to access this $124,000, guess what they got to do?
Borrow.
They gotta borrow it. They borrowing money from themselves, so if they take out, how much?
100,000.
100,000 and die the next day, what does the family get?
50,000.
They get 50,000 because they gotta pay back the loan that you took out. So I went from the bottom straight back to the top. See, once I hit the bottom, ain't number one way to go. To the top. That makes sense? So they got 124,000, but they borrow 100. They family not gonna get 150,000. They gonna get 50 because they gotta pay back the loans that they borrowed from themselves. So some people get smart and they say, "Well, I just won't borrow." Well, great, don't borrow. If you don't borrow and you die, your family does get the 150,000, but the insurance company keeps
The 124.
the 124,000. If you die and get the insurance, you lose the savings. If you live and take the savings, you lose your insurance. You paying for two things, but you will only get one. Insurance is for if you die. Savings is for when you live. You can't live and die at the same time. So since you can't live and die at the same time, why would you bundle your savings and your insurance together? It makes no sense, does it? Right? See, you see how I'm engaging them in the conversation. I gotta engage you in this conversation. I gotta make it make sense. But I'm going from top to the bottom. And once I get to the bottom, there's only one way to go. Back to the top. You got 124,000, but you borrow 100. Family ain't getting 150. They get 50 because you borrow from yourself. See, all the pausing makes a difference. You borrow from, and you let, why do I pause?
To make them answer.
And get, so I gotta make sure they capturing this. If they ain't saying it back to you, they're not grasping it. They ain't feeling you. You gotta make sure that they doing that. Cause then they get in the conversation with you, then they gotta get just as mad as you are about it. That's why you can't be sitting there calm. That's why you can't be sitting on, no, look, this is what they doing to our community. So you gotta be like Martin Luther King was. Right? He was passionate. He was convicted by it. He said, this can't keep carrying on in this manner. That's how you get effective with your closing, because you gotta articulate in a way that they understand, you understand that we can't keep on continuing on in this manner. Does that make sense? All right. So Jasmine first and then Jackie, I want you to go top to the bottom, and I want you to make me feel like this can't continue on in this manner. Don't get so caught up in making sure you articulate all the words. I just need to feel the passion that this gotta stop.
Right.
Cause that's when people transition. That's when they move over. That's when they join, when they feel like this gotta stop. Does that make sense? You know, you ever been in a bad relationship? At some point you woke up and said,
That's it.
this it. This gotta stop. I ain't putting up with this no more.
Right.
And then you change. That's the feeling. The feeling that you had when you got tired of that Negro. Your clients gotta have that feeling.
Okay.
If they don't get that feeling, people make changes when they feel uncomfortable or disturbed. If they ain't disturbed and they ain't uncomfortable, because you can comfortable with them, and then you keep on doing what he do. But when you make him nervous, if he love you, he gonna get himself together. If he don't, you gotta change. All right. So you fed up. Okay? Give it to me. Fed up.
Fed up.
That's right.
Okay, so we look here. We have John and Mary, and they have 150. There's $150,000 on John, $150,000 on Mary, and they have $0 on their child. I guess nothing's going to happen to the child. Okay, so that's a total coverage of $300,000. So we look at this here. That's $295 a month. And the reason that it's so expensive is because they're paying for the savings here. So also their life insurance and then their savings. Okay. And assuming that they took this policy out at the age of 30, by the age of 65, they'll save $124,000. Okay. And so we look at this. If John borrows $100,000 from this savings here, which is separate, right? He's going. If something happened to John and he dies, Mary's only going to get $50,000.
Wait a minute. What?
And you look at it like, wait a minute, what? Because if John borrows his own money, right? So who put the money in there?
He did.
He did, right? And he, times are hard or whatever the case may be, he need to borrow $100,000. If something happened to him after he borrowed that money, Mary thinking she's going to get $150, which is what the policy's for, but that's not the case. John's gonna owe that money back. So now after death, we're looking here, Mary's only gonna get 50,000. And we look at this too, if you say, hey, I'm not gonna spend that. $124,000, this is, you're paying for two, but you're only getting one, okay? And we look here, if you don't spend the $124,000, who gets it? Who should get it?
My family.
Your family. But unfortunately, that's not how that works. If you don't spend this and something happened, only Mary's going to get the 150. They're not going to get the 150 plus. You're only going to get the death insurance company. Now, when you're saving your money, are you saving money to give it to your family, or are you saving it to give it to the insurance company?
I'm saving it to give it to my family.
Exactly. So is that fair that the insurance company is getting it after you're saving the 124,000?
No, they ain't. No,
It's
that makes
not.
no sense.
It's not. And so what we do is uncondition this concept here.
Okay. All right, Jack, come on, top to bottom.
Okay.
All right, so again, and that, I'm fed up. Like, I'm fed up.
Okay, so Miss Jasmine, we look at this here. Now, John and Mary both get 150,000. They don't put any money on the children, as if children don't die. And children die every day.
Exactly.
Their total coverage is 300,000, but yet their premium is $295.
See the difference there? See, I feel that, you know what I'm saying? It's a different level now. Her voice, her tonality,
It changes.
I'm fed up. Keep going. I threw you off, I'm sorry. But
You
yeah,
sure did.
but you was doing good. I had to stop it because when you're doing good, if you do bad, I be telling y'all do bad. When y'all do good, I gotta tell y'all doing good. I had to jump in there, yeah. Okay, all right, so, I'm sorry. Take it from the top. I just had to say that.
Okay. So Jasmine, Miss Jasmine, we look at this situation here, the cash value. You know, a lot of people have this option. However, John and Mary both have 150,000 on them. They have no money on the children whatsoever, as if children don't die.
Okay.
So their is 300,000, but their premium is $295 per month. Oh my gosh! And on top of that, they have a cash value of 124,000, as if they took this policy out at the age of 30. So by the time they reach 65, they have 124,000 saved up. Okay. John goes and borrows 100,000.
Okay.
Hard times hit up. He borrows 100,000. Something happens to one of them. First of all, I have an issue with the fact that they have to borrow their own money. That's the issue for me, and it should be for you. Wouldn't you agree?
I do.
Okay.
Yeah.
So John goes and borrows 100,000. Something happens to John or Mary. One of them die. They only get $50,000.
Wow.
Why? Good question. Because John got $100,000 of his own money. His own money he borrowed.
Wow.
So he has to pay that money back to the insurance company. Money that he saved up. So some people say, well, you know what? I'll get smart and try to outsmart the insurance company. I just won't borrow. The insurance company say, yes, great, awesome, don't borrow. What happens to that $124,000 that you saved up? Your hard-earned money that you saved up, what happens to that?
That should go to my family, right?
You would think so,
Wow.
but that's not what happens. Unfortunately, that $124,000 goes back to the bank. Yes. Yes. So you have two options. You have two things here bundled into one. Your insurance is for when you die. Your savings is for when you're living. You can't die and live at the same time. So why would you bundle these up together like this?
Should.
You should not. Absolutely.
Right, so that's good, that's great. So now when you go in there, they got it. It was passionate, right? They was feeling you, right? But now I got to go and be as passionate about the what?
Solution.
The solution, right? So at this point now they got it. He borrowed his money. His family should get it. They gonna keep it. So here's my transition. So if you went to the store, right, and you bought a pair of shoes, if you get back and there's only one in the box, what would you do?
Go back to the store.
I'm gonna go take it back, right? So we teach people how to take this back, because if you're paying for two things, you should get two things. So we show them how to switch to primary term. Now, there's a reason it says change the primary term. It didn't just say change the term. It said change the primary term. Why? Because we let them know we doing business. right? Change the primary term, put 400,000 on John, 400,000 on Mary. We put 10,000 on the kids and the grandkids. I always throw in the grandkids too, because we need to make them understand that we got a superior product. We put 10,000 on the kids and grandkids. So with us, they're only paying $126 a month. Now think about this. We gave them more than double the coverage for $169 less per month. How in the world can we do that? Because we're not tricking them and making them think they got this savings account they got to borrow for themselves. We're giving them pure debt protection. When you die, you get this amount of insurance. That's why we gave you double the coverage for almost half the price. And we encourage you to take this $169 that we freed up and put it into a separate investment account, assuming a 9% return. If you put it in a separate investment account at age 65, instead of having $124,000 to borrow, you got $500,000 you can take anytime you want to. Now I know it's a lot, right? But just think about this. Just answer a simple question. If we call this bank A, where you got $150,000 coverage and $124,000 that you can borrow from, this is bank B where you got $400,000 in coverage and $500,000 you take anytime you want to. Which one of these programs would you rather be in?
Bank B.
It just makes sense, right? But the world tells us that we shouldn't buy term insurance. And the reason they say we shouldn't buy term insurance because it's going to terminate. That's what term means, temporary. It will terminate. And it does. Our policy take you out to age 95. Whole life take you to age 100. But by any scenario, age 95 or age 100, where you probably going to be?
Dead.
You're going to be dead either way. So the question is, would you rather be dead with $500,000 or dead with nothing? You're going to be dead. So we teach a concept and tell me if this makes sense to you or not. Right? I always ask them to tell me if this what?
Makes sense.
Why? Because I need to know if it makes sense or not. If it don't make sense, tell me it don't make sense. So we look at a theory called decreased responsibility. It is just simply how life works. So in our early years, we got young children. We got debt payments. We got mortgages. So a loss of our income can be devastating to our family. So in our early years, we need a lot of protection. Hence, that's why we get term insurance. Term lets you get a lot of coverage for a little bit of money. But in our later years, our children are grown, aren't they? See, 30 years from now, my term is up. My kids are grown. 30 years from now, my debts are lower. 30 years from now, my mortgage is either paid down or paid off. So in 30 years, do I still need as much coverage?
No.
I don't. But even if I just wanted to keep it anyway, if I got $500,000 saved, can I afford it?
No, definitely.
Yes, I can afford it. So from there, we do a simple concept called the dime. It sums all this up. Jackie, give me a dime. Or give Jasmine a dime. We do a simple concept because we got them conceptually involved. Don't be waiting on permission to show them their numbers. Right? I got you already involved. You caught up in the concept. You told me bank B makes more sense. You shaking your head yes when I say in my later years I don't need as much coverage. They telling you, okay, I feel you. So after they say they feel you, don't be pausing. Don't be like, can I show you some rates? Don't be none of that crap. So we sum this up with a simple process called the dime. Then see people end up closing. They don't even know how to end up closing. I'm moving straight on through. You're going to tell me if you don't want it or not. And if you don't love your family, I can't change that. You know what I'm saying? But we sum this up in a simple concept called the dime. Tell me if this makes sense to you or not. Now, when I go through the dime, when I'm doing a presentation, I use hypothetical numbers if it's a recruiting appointment. I'm sitting with a dude, and he ain't got his wife there. I ain't trying to write him up. Because what he going to tell me?
Yeah, wait.
Yeah, wait. So obviously, if I'm sitting there with just a dude, this has got to be just a recruiting appointment. I must have no expectation to sell life insurance because I shouldn't be sitting with a dude without his wife.
Right.
So then I'll use hypothetical number. If I'm sitting back with a woman and she with child, I ain't using let's say you made $2,000 a month. No. If you die today, who get the kids? That's what I want to know. If you die today, who get the kids? How much do they need to come in every month? Because you ain't coming home no more. When your heartbeat stops, so does your check. What do they need minimally? See, that's why I say minimally, because if you're with a new recruit, you're not asking people what they make because they're uncomfortable with saying what they make in front of somebody else because they've been lying to them all this time or letting them assume whatever they want to assume. So I say, how much minimally? So the other person sitting beside, when they say $4,000, they be like, that's all you make. You ain't got that feeling. You said they at least need this to come in. That's why I use that language. So minimally today, Jasmine, what does your family need to keep coming in? So go through the dime process, but get her to give me her numbers. Does that make sense? Because I need her now. This ain't no third party no more. We ain't talking hypotheticals. We ain't talking about concepts right now. We talking about you. Once I know you understand the concept, let's talk about you. But throughout my presentation, I never was talking about you. Throughout the presentation, I'm just talking about the concept. And I need you to be like, yep, that makes sense. That makes sense. Oh my God, this makes sense. That's how your clients gotta be. That's why you gotta exude your passion. That's why you gotta talk like you fed up. Or Williams is so effective because he says this and that he gonna correct the what? Injustice. And that's how your presentation gotta come across. Now let's talk about your situation. So go ahead, Jack, and talk about Jasmine's situation.
Okay. So Jasmine, after we looked at those those scenarios, now I'm gonna show you a concept called the dime.
Okay.
And this is basically how we determine how much life insurance one needs. So I see that you're with child.
Okay.
So we do a simple concept called the dime.
Okay, now let me say this. I don't use the word life insurance, hardly ever.
Okay.
Right? So, Jasmine, so now you see the concepts make sense. And from here we do an illustration called the dime. It's an acronym, right? To see what your protection needs are. I barely say insurance. Every now and then that slips out, but I don't want them thinking about life insurance.
Right.
Because then they mind saying I got something on my job again. Then they mind saying I got a little $10,000 policy. I want them to almost feel like this ain't life insurance.
Not right.
Right? This is your protection plan because we talking about debt, income replacement, mortgage, education. We talking about these are your protection needs in case you don't make it home today. This is what your family need. So I try to, every now and then I may slip out with the word life insurance. So we do a simple concept called the dime and it looks at your protection needs. Okay?
So Jasmine, we after looking at those two scenarios regarding the cash value and the term, we do a simple concept called the dime to see what your financial needs are. Okay? And we use this acronym called the dime. Right now, do you know what day you're gonna die?
I don't.
Okay. So the average, the D is for death. So the average funeral today's market is anywhere from 7,000 to 8,000. But due to the fact that you don't know when you're going to die, it could be 5 years, it could be 10 years from now. So we're going to put down 15,000 just for inflation, because as time go on, funerals increase. The I is to replace your income. Right now, hypothetically, let's say you don't make it home tomorrow.
Okay.
On average, how much would you need to replace your income?
I say about 2,000 a month.
2,000 a month? Great. So we say 2,000 a month times 12. On average, that's 24,000 a year. Okay?
Okay.
And since you're with child, you would want that income to come in for how long to be able to take care of your child?
I would say for at least
A minimum of,
15.
okay. But just for illustration purposes, I understand you say 15, we're gonna put down for at least 10 years,
Okay.
okay? So that's already $240,000 already, just to replace just the basics for your income, okay? Or are you renting or buying?
Renting.
Okay, so the M is for mortgage protection. But in the future, I'm assuming you do plan to purchase and be a homeowner. So if we would need to replace your mortgage, because you wouldn't want anything to happen to your child, and then she has to be evicted from the home. Because Bank of America doesn't care about the fact that something happened to you. If you don't have that money, that money to pay the house off, the bank want their house back. Right?
Yeah, they do.
Okay. And the typical average cost for someone in today's market is about $100,000 to pay their home off.
Okay.
The education, assuming that you want your child to go to college,
Okay.
Um,
Yeah, I do.
major university, 4 years, on average, that's easily $100 grand.
Really?
So how we figure out what your financial needs are is we would add up all these acronyms. Again, the D being for your death protection, I being to replace your income, which was the 240,000. The M would be to replace your mortgage if something was to happen, so that we will be able to protect your mortgage. The E is for education, so that your child would be able to go to school, get an education, or what have you. So when we look at this and add all this up, this is $455,000 worth of coverage that you need, according to what you told me, correct?
Correct.
Now, looking at this here, Jasmine, is there anything on here that you don't need, or that your child would not need?
No, I need it all.
You need it all,
All right,
absolutely.
so I want you, the first thing you want, first step is you gotta get them to agree that's a lot of insurance,
Okay,
cause that's what's in their brain.
mm-hmm,
So when you say your need is 455,000,
mm-hmm,
Jasmine, that's a lot of insurance, isn't it?
It is. Yeah.
But if you was to die today, what on here can you say,
you don't need it.
no? What on here can you say, yeah, what on here can you say, my family don't need it? Now, see, like I do that every time, right?
Yeah.
Why is that point impossible? Why is that important?
Saying you don't, you
It's
forget about it.
dismissive.
It's just
Ain't
dismissive.
nothing. What on here can you say, they don't need that.
Right.
Now, they need it all.
Need it all.
Matter of fact, Jasmine, if it was,
Free.
would you take it?
Yes.
I need her to say that.
Okay.
And then my only job is to do what?
Give them
Closer.
free.
Get you as close to free
Free
we
as
can.
possible.
Get you close to free as possible.
Okay,
Okay, obviously I can get you free, but I'll get you close to free, but I'm gonna get you close to what you need, but at a price that you can,
afford.
price you can afford. And what's my basic plan should show? How much should a basic plan say?
150,
150.
No, not the coverage amount. How much should the check be?
50,
No, 64.
$65 should be the minimum plan.
65.
65.
That's what you for,
65.
65. All right, you want your average premium to really be about, they can't afford it, they'll let you know, you can work it down, but you calculate whatever $65 and give them. That's what you really want your basic premium to be in front of, about 65. And I mean, obviously, they're just saying that when you look at the needs, you know what I'm saying, the need, you know, you send them out, somebody don't need 150,000 coverage, it's gonna be pretty tough to do. But in most cases, if they needs come up to $500,000 or whatever, then you gonna make that first one gonna be the $100-some, the middle one you want to be kind of right at about $84, $83, somewhere up in there, and then the basic plan, you want to right about 65. And it's important to get your premiums to about $65. No checks for $65, $85, and $141, because guess how much their cell phone bill is?
200. It depends.
People spending it. They spend it all day. When is money an issue?
When it's like a value.
Absence of value. That's when money is an issue. All right, so last thing, Jasmine, I need you to recruit me. All right, so assuming we already talked about they picked the $83 plan, right? Right, we're saying if they picked the $83 plan, I need you to recruit me into the business.
Okay. So, Rico.
She remember my name.
So, how long did it take Jackie to explain this concept all about?
10 minutes, maybe?
10 minutes, okay? And so, what I want to show you is our conversation, how much Jackie got paid on this sale, okay?
Okay.
So, for this, say $83, we take that, we multiply that by 12, right?
Mhm.
So, that's about $1,000, an average of $1,000, right?
Mhm.
After field training, what we'll do, once you go through your training, you graduate to our next level, which is 50% contract. So we look at this here, that's $1,000 divided by 2, what is a half of 1,000?
500.
500. So, not to tell your business, Jackie, but Jackie made $500 on this, for this check of $83. She made $500, and that took 10 minutes. So, of that $500 taking 10 minutes, would this interest you at all? If it only took us 10 minutes to explain this concept called a dime, and she only made 500. So, how long at your job is going to take you to make 500?
A whole week of work.
A whole week. And what we want to do is take you out and train you, so we can show you this concept, the dime. You just show people the dime, and you can make this kind of money in less the time. Would that interest you at all?
No, I wouldn't be interested in that.
You wouldn't? Would you know anyone who is interested in making that kind of money in less of the time?
No, I don't really know nobody.
You don't know nobody that can do that?
No.
Cause this, instead of working a week, you do this in 10 minutes.
I don't know nobody. So
You gotta do something
right,
about
right,
that.
yeah, right, exactly. so when I was playing the
Uh-huh.
conversation, because you went over the
You got
numbers correctly, right?
Mhm.
But you don't want to be
Don't
like,
ask.
Yeah, no, you gotta assume that everybody that see this wanna do
Wanna
it.
do it.
That's kinda how to be your mindset, so I'm
Oh,
saying, like,
yeah.
yeah, you're right, so,
So-
hey, listen, so we look at $83 a month times 12 months, that's $1,000
That's $1,000.
that they'll pay for the year. So the way it works is when your training is done, you go to our graduated compensation, you get a 50% contract,
Okay,
right? So what's half of 1,000?
500.
So $500, how long was we here?
Not long.
You think about 10, 15 minutes, and we're at 500, even if we slow, it takes an hour or less, or an hour or less, you make $500. Let me ask you this, if I can take you out, your first 30, 45 appointments, I do the talking and you get paid at tune of $500 an hour, is there any logical reason why you would want to take advantage of that? I ain't say, are you interested?
Are you interested, right?
I said, is there any
Logical.
logical reason why you want to take advantage of that? I'm gonna do the talking and you gonna get paid. Any logical reason why you want to take advantage of that? See, and on top of that, see, your compensation is at 50%, but my job over the next 90 days is to get you up to a 110% contract. And that 110% contract, you think about it, if you go do that exact same sales, instead of making 500, you make 1,100. Imagine if you just went and wrote one person a week and you made $11 a week, that's 44 extra $100 a month coming in your house. Tell me how would that impact your household if you made an extra $4,400? How would that impact your household?
It'll help a lot.
It would help a lot, right? See, as significant as this $1,100 is, or as significant as a $500 is, it ain't even why I became part of Primerica. See, if you go write the sale and you're a brand new district manager at 50% and they pay you $500, if I did it, they're gonna pay 11. But you know, Primerica gonna pay out $1,100 no matter who, go pick up the sale. So if you pick up the sale and you make $500, I pick up the sale, I make $1,100. Primerica saying even when you pick up the sale and get your $500 and I was nowhere around, because I brought you into the business, because I trained you, they gonna pay me $600 every time you go pick up a check. So my job over the next 90 days is to go hire 10 people minimally in your business. My job is to go help you get to the regional vice president contract. So if 10 people pick up a check for $84 a month, 10 people do one a month, you made an extra $6,000. 600 times 10, you made an extra $6,000 because 10 people picked up one check. See, I was more interested in this concept because this concept doesn't require my time. And as I'm getting older and I'm ready to go retire and enjoy my family life, I got to figure out how to make money that do not require my time. We've been taught to touch to make money.
Right.
We've been taught that to make money, they got to require your time. And most people ain't got no time. Would you agree? Most people ain't got no time.
Right.
So Primerica showed me how to get my time back, but have money to enjoy when I get it. Hobos got a lot of time, but they don't have no. Doctors, lawyers got a lot of money, but they ain't got no.
Time.
Primerica teaches us how to get freedom of our time with money to enjoy. So, Jasmine, if I can position you where you made an extra $6,000 a month that didn't require your time, is any logical reason why you wouldn't want to come work with me?
No.
Okay? Well, Jasmine, listen, to get your business ID number is just $124. And that'll take care of your license, certification, your class, things like that. You want to put that on a MasterCard or a Visa today.
MasterCard.
Okay, good. And then you go close them. Now, if they come up with some logical reasons why this don't make sense, if it's logical enough for them, you know they ain't the one. You move on. Some people gonna come up in their mind with some logical reasons. If it makes sense to them, ain't nothing you gonna be able to do about it.
Right.
But you should be thinking that there's no logical reason why they wouldn't do it.
Okay.
Does that make sense? So that's what you want to work on. You want to work on making sure this makes logical sense to them. And if it don't make logical sense, one of the reasons why it typically don't make logical sense if they people that's ambitious. Some people just not ambitious. Y'all understand that, right? Some people not going to join the company because they okay with 9 to 5, paycheck to paycheck. You can't do nothing about those people. They ain't the right ones.
Right.
But the people that's hungry and ambitious, when you get around an ambitious person, they should be writing you a check for 124. And if they don't, it's just simply because they ain't got the 124. Jackie learned the secret the other day. You put the IBA in and the screen go blank. She's like, what's going on? The screen keep going blank. I'm like, Jackie, ain't no money on their card. Like, no, they got money on their card. Like, no, they don't. And so when the screen go blank, that means there's no money on the credit card. They ain't got it. But they also let you know they let you know I'm ambitious.
Right.
And if I had it, you can have it because I want to be a part of what you're doing. But if they ain't ambitious, and they ain't money motivated, they ain't the right one for your team anyway. They're going to cause you a headache. You going to find yourself always calling, you ready to go on an appointment? You ready to, listen, and I ain't never got to call her and say, you ready to go on an appointment. I got some more appointments. You better hurry up because other people I got some more appointments. Come on, I need them to. See, that's how ambitious people work. You don't get caught up on the people that's not ambitious. You got to go to the next one. thing going for your business. But you gotta make sure you articulate the crusade
Okay.
in your presentation enough where when they seeing it or hearing this presentation, they say, man,
Gotta go.
this makes sense. Man, my people need this. And as long as you portraying that, if they ambitious at the end, all you asking, I go out here and we do this in less than an hour, you make $500. Jasmine, any logical reason why, if I'm gonna do all your talking for your first 30, 45 days, I'm gonna do all your talking, is there any logical reason why you wouldn't work with me? And she say, no, I know she's ambitious. If she say yes and start making a reason, that just tells me she's not. How much more time I'm finna spend with her? I'm gonna show her the franchise model, say, listen, I wanna get you your time back. Your contract can go to $1,100 on that same sale. And the beauty of this is that you can go hire 10 people at a 50% contract, they make 500, every time they make 500, you make 6, and it didn't require your time. Now, if they still got some logical reasons, guess what it's letting you know? He ain't the one. You gotta go look for some more. Get away from them, because whatever they got could be catchy. Might jump off on you. So you close it on down. Does that make sense? All right, any questions before we wrap up? Anybody got any questions? Everybody this makes sense to?
Makes sense.
Everybody ready to go out to be ambitious? Money motivated?
I'm ready.
Excited?
You got one line that you said that Primerica teaches to get freedom.
Freedom of our time with money to enjoy it. Because people work and they got to exchange their time for money. You can't get wealthy exchanging your time for money. You got to figure out how to make money that doesn't require your time.